Yo trading floor. Wild card in the building. 4 monitors. Rockstar cracked. DFV. The kitten using my keyboard as a bed. Wednesday, June 17th. Warsh's first FOMC. Oil cracking below 80 for the first time since the war. SPCX. At 3 trillion with a 5% float. Private credit defaults screaming while equities throw a party. We got a lot to unpack. TB, you with me?
I'm with you. Quick disclaimer, we're two guys who watch charts all day, not financial advisors. Do your own research before you touch a single ticker. Let's set the tape.
Futures are treading water. Barely changed from overnight. VIX still in the teens, which feels wrong given everything happening. Oil's the anchor. It closed below 80 yesterday, and this morning Asia and Europe are digesting it. The 10-year yield dropped to 4.43% as bonds front-ran the disinflation. The tension is simple. Equities are pricing peace, bonds are pricing demand destruction, and physical crude barrels still aren't flowing through Hormuz. One of those things is lying.
They can't all be right. And at 2 p.m. Eastern, Kevin Warsh steps up for his first Fed decision with oil down 15% in a month on his desk. That's our show. Top stories. You're leading with oil.
Oil below 80. Every headline this morning. Crude crashes on Iran peace deal hopes. And it's true. We saw Brent break that psychological level, and now the bulls from last month are nowhere to be found. But let's talk about what the price is ignoring. The Strait of Hormuz is still a no-go zone. The MOU says 30 days for shipping to resume, with mine removal supposed to finish by the end of this week. 30 days. There is not a single supertanker that has transited that choke point since this war started. The price is moving on hope, not a single barrel of physical delivery. And the IEA dropped their report this morning. 700,000 barrels a day downgraded on demand. Q2 deliveries plunged by 5 million barrels a day. They're already talking about a global supply glut by 27. So the narrative flipped from how high can oil go to how fast does demand recover and when does the glut hit? That is a demand destruction rally, rebranded as peace. The Vance interview yesterday confirmed the deal structure. No U.S. money goes to Iran, only foreign investment if they behave. That's a very different deal than the JIPOA. The Gulf Arabs are celebrating. Obama's people are fuming, but the market is pricing it as done. Before the memorandum even drops on Friday, the divergence is huge. If the deal stumbles, and it's incredibly fragile, oil snaps back to 85 violently. If it holds and the strait reopens, crude drifts to 70 or lower. The range is wide, and risk is asymmetric. That's the setup. TB, walk me through Warsh at 2 p.m.
So Warsh walks into the room with oil crashing, yields already down, and the stock market expecting a dovish nod. Consensus is a hold, neutral language, door open to cut. That's the easy path. The real tension is the dot plot. The holdover governors had 2 rate hikes penciled in back when oil was at 90. If the median dots still show those hikes after a 15% crude drop, that's a policy error, and bonds will smell it immediately. I think they adjust down, because nobody wants to be the hawk whose dots caused a bond tantrum on the new chair's debut. But if Warsh hedges too hard, if he says they need more evidence, before acknowledging the disinflation, that's a hawkish surprise for a market that already priced in a soft Fed. Equities sell off into the close. And here's the cross-current nobody's connecting. The BOJ hiked on Monday to 1%, highest since 1995. Japan is tightening while the Fed holds. The yen carry trade unwinds further. If dollar-yen breaks lower, leveraged positions in U.S. tech come unglued. That's an accelerant. If equities get wobbly at 215, that carry unwind amplifies the move, whether it's up or down. So the risk isn't just the statement, it's the hidden plumbing underneath.
That's terrifying. And speaking of things that feel like a setup, SPCX. SpaceX passed Microsoft in market cap Tuesday. SpaceX valued around 3 trillion. Figures vary, with a 5% float. Options. Volume. Over 500,000 contracts in the first hour of trading. Implied volatility spiked to 300%, then got crushed to 200% intraday. Call buyers got obliterated. It's a circus. The float is 5% because retail got extra shares. This is a pump squeeze. And the lockup expires at the end of June. 2 weeks. The insiders who've held for a decade are about to be able to sell. When a 5% float becomes whatever percent after the lockup, the math works only one direction. Stocked Up is calling a crash by end of week. I don't know if it's Friday, but I know the lockup date is the real event, not the options mania. The fundamentals. $18.7 billion in revenue last year at $3.265 trillion. That's a 174 times trailing revenue multiple. SpaceX is incredible. but priced for perfection in perpetuity with a float that's a math glitch.
And while everyone's staring at that ticker, the credit market is flashing a warning nobody wants to see. Yesterday, SPY up 1.7%, Qs up 3%. Same day, the Kieber Private Credit Index, $300 billion in loans, default rates matched the 23 high. That's the exact level that preceded the regional bank stress. The bond market is not buying this equity rally. Yields dropping on economic weakness, not soft landing confidence. The 10-year at 4.43% is whispering, recession, not everything's fine. Private credit is the canary. Last time we saw this, it took months for equities to catch down, but they did. One of these markets is wrong.
And the China story ties it all together. BMW hit its second profit warning in 2 months, squarely blaming China. The EU just revealed China trained Russian troops. Trade war is escalating, and that IEA demand destruction report. 5 million barrels a day of vanishing demand confirms it's not just a peace narrative. Lower oil isn't a pure supply relief. It's a global consumption recession signal. But here's the twist. TB, you got BYD as the counterpoint.
Yeah, BMW is screaming that the German luxury China is dying. But BYD, ticker BYD, down 1.4% on a Pentagon military label headline, not on demand. China's auto EV demand data is still strong. This is a structural rotation. The China that bought imported 6-cylinder sedans is shrinking. The China that builds its own supply chains and buys domestic EVs is growing. It's not a uniform collapse, it's a K-shaped one. My paper account is long. BYD bought the Pentagon dip at 87.50, now at 86.47, down $1. Stop at 82. I'm not betting on China's macro recovery. I'm betting on the sector that's absorbing the spend BMW lost.
Now let's hit the calendar and sector flows. Earnings this week. Actually, Jabil and CarMax are reporting today, both with notable estimates. Not a ghost town. No big beats, no big misses. Next week we get Micron and Nike, but today, crickets. So, we move on. Economic calendar. TB. Walk through what matters.
Right, no earnings noise. For macro, today we got GDP now steady at 3.3%, no surprise. Japan's Reuters Tankan Index prints tonight, prior 8, so watch any dip below 5 as a BOJ sentiment check. Tomorrow is the dense day. UK. CP, I expect it to accelerate to 3% year over year from 2.8, core at 2.7. Eurozone CPI also up, core at 2.5 from 2.2. If both print hot, it complicates the global disinflation narrative, especially with oil already down. Then, U.S. retail sales, consensus 0.5% monthly, core 0.6%. A miss there validates the demand destruction story, could push yields even lower. Lagarde speaks too, but she's usually a non-event. The big one, if retail sales disappoint, it reinforces that the consumer is cracking, and that's the recession signal under the oil move.
Sector rotation paints a weird picture. 1 week look. Materials up 3.84%, financials up 3.6%, technology up 3.14%. Risk on, right? But energy down 3.54%, healthcare down 1%. Money is chasing cyclicals while fleeing the commodity sector that led the war trade. That's a rotation into hope. But if oil snaps back, energy names reverse violently. And if credit stress builds, those financials could get smacked. It's a fragile breakout.
And internationally, Asia gave mixed signals overnight. Nikkei up 0.72%, Kospi jumped 1.58%. Korea loves any tech optimism. But Hang Seng down 0.74%, Shanghai barely up, so China skepticism persists. Europe, DAX down 0.5%, FTC slightly red, Stocks 50 flat. US, DJPY dipped, yen strengthening a touch. That's the BOJ hike settling. If the yen keeps creeping higher, the carry trade unwind hits leveraged longs in the Qs and SPCX. The macro plumbing connects directly to your US names.
Which brings us to the portfolio hot news, the oil divergence, and what I'm doing about it. I'm staring at a setup where price says peace, reality says Hormuz is closed, and the IEA says demand is crumbling. The bull case for a snapback. The deal is fragile. The MOU could stumble, and if any negative headline hits before the memorandum, Friday, oil rips back to 85 in a session. The bear case, the deal holds, the strait reopens on schedule, and demand weakness from China confirms a glut. Oil drifts to 70 by summer. Second-order effects, a snapback spikes inflation expectations and forces the Fed to stay hawkish, which would kill this equity rally. A drift lower crushes energy earnings and might spark credit losses in high-yield energy debt. This divergence can't last. So here's my trade. My TFT algo is mostly cash, sitting on about 99,000, my gut call paper account. I'm putting on a small tactical long in the United States Oil Fund, ticker USO. Not big, $1,000, near dated. I'll set a stop at 72 on West Texas Intermediate crude, target 82. That's a 10% upside, $4 risk. Asymmetric enough. If oil breaks below 72, the peace trade is real, and I'm wrong. If it snaps, I capture the reversal. DFV. The kitten is unimpressed. He yawned at my screen.
And my counterpoint is that the China rotation is the smarter play. Not oil, but the sector that wins when the old economy shrinks. My wave trader algo is holding 14 positions, 11 slots open, gates filtering tight, no new entries in a session. My paper book, BYD down a buck, stop at 82. The real story is that BMW's pain is BYD's gain. If oil's demand destruction narrative is correct, EV makers with domestic demand are the winners, not the levered crude bet. That said, your oil trade is small, cheap, and fits the asymmetry. I respect it.
All right, let's close it out. Here's what we're watching tomorrow. Number 1. West Texas Intermediate crude. Key level 72. If that breaks, the peace trade is real and oil heads to 70. Number 2, the 10-year yield, 4.43%, is resistance. A break lower signals recession fears ramping. Number 3, SPCX. Lockup expiry, June 30th. Watch for insider selling signals and option implied volatility crush. And number 4, U.S. retail sales, Thursday morning. Consensus 0.5%. A miss confirms the consumer cracks. Keep your stops tight and your conviction looser than your grip. Charts don't care about your feelings, but they sure do troll your stop. Wild card out.